You're tuned to the Leadership Strategy Foundry with host Neil Evans. In each episode, he interviews top influencers in the financial services business sector. One of them might just spark that idea that ignites your bottom line. Here's Neil.
Welcome to today's episode of the Leadership Strategy Foundry. For those of you just joining us, we specialize in helping portfolio operators and growth-focused companies identify opportunities to scale revenue and improve execution across their business units. Today, we're joined by a guest with unique perspective on building and investing in companies. Today's guest is Matt Van Eerden of Joshua Tree Partners, a private equity firm focused on investing in growing lower middle market businesses. Matt brings a practical perspective on working alongside management teams and navigating the realities, building value through operational execution. Matt, great to have you on this episode of Leadership Strategy Foundry.
Great to be here. Thanks for having me.
All right. Well, we'll just jump right in, right? So let's start at the beginning. What originally pulled you into private equity and working with lower middle market companies?
I think it was a few years ago. I came to the realization that I wanted to be like an operator. I wanted to be an entrepreneur. I wanted to be leading my own company, and that might be like a non-traditional way of ending up in private equity. But with the search fund model, it works. Once I learned about the search fund model and started talking to a few people, within this ecosystem, I realized, this is exactly what I want to do. I want to lead a company. I want to take real ownership of it, provide, value through doing that, and then, not take a portfolio approach really, where I'm, hands off and more of a financial manager, but actually being a leader.
Yeah. So first of all, I'd like you to talk a little bit about your journey getting there. And, you're a Marine veteran. Thank you for your service. And also then maybe after that, just go right into educating the audience about what a search fund is.
Yeah, sure. It was one of my first roles after getting out of the military. I was a Marine infantry officer. I did 2 tours in the Middle East, and getting out of the military, I didn't really know exactly what I wanted to do. I ended up taking a job for a company called Ecolab, leading a team of salespeople. And my boss, I thought he would be a great mentor and help me transition and make that transition in the civilian world. And he ended up just throwing me to the deep end, giving me the team, saying, "Hey, hit your number." And he talked to me maybe 5 to 10 minutes a week. And so what I realized during that experience is just how empowering and motivating that was for me. And so from there, it's just been a process of trying to figure out how to become an entrepreneur. I went to business school. At business school, I realized I do like entrepreneurship, but I don't love the idea of, taking on all that risk of going out and doing a startup. I'm not a startup person. I don't feel like a visionary in that way. So I heard about this idea of, doing a search fund. And so the idea is you go out, you raise a small amount of capital to cover things like expenses, you bring a group of investors together, and then you spend, 2 to 2.5 years looking for a business to acquire, like one business. And the fundamental thesis is there's this group of, the largest group of entrepreneurs in our nation's history, the baby boomers who have companies that maybe they've been running for 30 years. And now they're looking at retiring and they don't have a great exit. Their business isn't sellable in the conventional sense to private equity or strategic or what have you. Or maybe they just have more in mind than passing off that company and letting it get gutted or rolled up into a big company. And they want to have, some real, effect or control over who's taking over that business, in terms of legacy. And so, you marry that concept, those business owners with guys like me and women, as well, who, want to be entrepreneurs and don't want to do a startup. And so that's the fundamental thesis behind a startup. It's not a new concept. It's actually started back in like the 80s, but it has caught on slowly. So I think by like 2000, there'd only been a couple dozen. By 2020, about 400. And
Hmm.
now I'd say we're well over 1,000 of us in the United States today, and it's exploding internationally as well.
Interesting. Just out of curiosity, what niche are you picking to target?
Yeah, absolutely. So when I started out, I was very broadly focused. There were a few different sectors I liked, but it was mostly blue collar business services. I ended up looking at things like HVAC, plumbing, electrical technicians, stuff like that. And then I ended up finding for-profit higher education, which was a really interesting space. I ended up moving off of that, and most recently, I'm focused almost entirely on aircraft, specifically aircraft parts, the manufacturing, the maintenance, repair, and overhaul of aircraft parts, and then also just like the brokering of aircraft parts. So that's maybe, three different industries there in terms of both the aftermarket and um, the OEM tier three, tier four, you know.
That's pretty
Yeah.
nichey, Matt. That's pretty nichey. So when you're evaluating a potential investment, what tends to stand out early? I mean, how does that typically play out as you get deeper into a deal?
Yeah, so the big things that stand out early are seller motivation, recurring demand, and owner dependency. I think those are like my big three. So in terms of seller motivation, like this is something I try to assess super early. This is maybe the most important thing for me, and it's understanding why an owner, wants and needs to sell. And so if they're not selling for the right reasons, or they're just, shopping for the best price, or maybe, worst case scenario, they're trying to jump out of a burning building. Um, that's something I want to assess early because I don't really have the time or the capital in order to figure that out, or at least, handle that broken deal when it inevitably, comes time to, move forward or the deal gets difficult. In terms of recurring demand owner dependency, recurring demand is pretty crucial. We're looking for businesses that are growing and are working because of the business fundamentals and the industry fundamentals, as opposed to something that's very relationship driven. And so, that's important as well as, that's important in terms of the owner, but it's also important in terms of the industry dynamic. So, imagine if an industry is highly cyclical or a business is highly cyclical, it's not going to be able to handle the debt that we need to put on it in order for it to be a good acquisition. And then in terms of owner dependency, by itself, if the business is largely being driven by relationships that the owner has, or the owner is too heavily involved in the business on a daily basis, that's not an ideal scenario. And it's not a scenario in which I can come in and, effectively take over their role without harming the business.
Right. That's got to be a kind of a tough call from looking at outside lens, looking into a founder and saying, is this business, his golf buddies? Is that it? Or, does he actually, build normal business types of relationships? It's got to be a little tough to dissect those two factors, I imagine. Yeah.
Yeah, no, it is. It's difficult to assess, and you try to do your best on the front end. But I think, generally speaking, this is something you can figure out during diligence, deeper in diligence. But you just try to assess it as best as possible on the front end. So, in my situation in particular, I don't end up spending all this time and money on diligence, and then, the deal is in.
Right. So as you work with companies after the investment, where do things most often not go as planned, as you foresee? Now, you haven't had one, so you're looking at from an outside lens of what you've experienced from dipping your toe in it, right?
Yeah, so I've seen a couple different things, and there's lots of stories and actually like podcasts about this topic, and they're cautionary tales. So just as like a few examples, customer concentration, and the company's reliance upon certain customers within their customer base can be a huge issue. And so if one of those customers decides to pull out, and it can pull out for all sorts of reasons. I mean, you're about to put this company through a huge transition, but then there's all the outside factors as well in terms of industry dynamics and stroke of the pen risk, like government making changes. And so that's a very big one. If all of a sudden maybe 20% of your revenue drops away within that first year or two, you're in a lot of danger of, not being able to cover your debt expense, but then also other customers leaving, or just generally speaking, the business not being able to, provide the return that your investors are expecting. So that's a big one. Another thing that happens is it's hard in a niche industry for someone from outside the industry to step in and
Mm.
lead. And so that's a conversation that I have to have with myself constantly. Like, is this business a business that I feel like I can lead? Do I have knowledge gaps? Are the people going to want to follow me within this business, given that I'm an industry outsider? And I have to be really honest with myself about that. Even outside of owners' willingness to help train me. And so that's another one. And then, a third one I've seen, and I kind of mentioned this, is stroke of the pen risk. So um, investors in this space really hate stroke of the pen risk. When I was looking at for-profit higher education, that's an industry where the federal government controls a lot of your revenue as a business. And so there are numerous instances, including in for-profit higher ed, where entrepreneurs like me have bought businesses, and then that business has gone through huge like revenue declines as a result of just government changes, regulation changes.
Oh, yeah.
So those are a couple of big ones.
Yeah, for sure. So w when something starts to go off track inside a portfolio company in general, how early, can you usually see it, and where does it tend to show up first? I know some of these questions are a little hypothetical for you, but I know that you observe very, very carefully this especially this niche that you're targeting. So,
Yeah, so I'm not the best person to talk about what happens within portfolio companies, but I can speak to this in regard to one particular example I've seen, and I think it applies broadly. So, there was an instance where an entrepreneur, again, like myself, a searcher, eh, purchased a company, acquired a company, and then that company lost, a really large customer. And so, in that scenario, the CEO, the searcher, really had to go into full gear, like sales mode. And so they became like the chief revenue officer to the nth degree. And that became their full-time job. And they ended up having a decent outcome because of that.
hmm,
So that was a big one. And then in terms of with the deals that I'm working with, the biggest thing that I run into is just transition readiness and trying to assess whether or not the owner is actually ready to step away. That's
hmm.
the biggest thing that I have to look for. And so, if the owner's not fully aligned and, we're getting late in the process and they might, be looking at signing on the dotted line and they're not quite ready, that's a really big problem. But even earlier on in the process, if I see them hesitating or even just taking an extra day to reply to an email with a simple request, those are all negative signs that, in my experience, mean that the deal is probably not going to be moving forward fast enough for it to work.
Gotcha. Just in percentages as opposed to not asking you, personal numbers, but of the deals that you're trying to harvest, how many look promising versus the field that you've actually expended effort into, evaluating for yourself?
Yeah, so I would say 1 out of 10 businesses that I look at, maybe even 1 out of 5, look good and look like something that I could bring to my investors and feel, really confident about taking to the next level, growing, myself with my resources. But that doesn't speak to, the likelihood that the owner is going to be properly motivated. It doesn't speak to whether or not this is a business that we can, buy at the right price, or a business that the transaction economics are going to make perfect sense. So I would say I've actually got pretty wide criteria, and I feel pretty confident within the spaces that I've been looking that
Mhm.
I can take a business and make it go. And of course, we're looking for, generally speaking, we're looking to double the revenue roughly over like a 5-year time frame. We
Mhm.
don't necessarily have a fixed time frame in mind, but that's generally where our heads are at in terms of making a business acquisition work.
On the opportunities that seem good to you, what what constraints still kind of stand in your way of taking those opportunities?
So in terms of the businesses that look good,
Yeah.
yeah, so there's all sorts of constraints. So, my job is largely a sales role. I have to sell my investors.
Mm-hmm.
on that business. And then I have to sell the bank on that business. And then I have to sell the owners on potentially selling me the business and selling it to me, at a price that's reasonable and providing at least some amount of seller debt.
Mm-hmm.
And so those are, I think, the big factors that sort of stand in the way. And then there's some other, diligence related factors, making sure that, the customer concentration is low enough, making sure the numbers actually add up, making sure that there aren't going to be like huge working capital constraints to growth, things like, that you would typically look for in diligence.
And I guess I forgot to ask you, but revenue size for an organization you'd like to take over, are you talking everything from zero, like maybe, or does it need to have a base for you to want to get in there? Can you just give us a kind of a
Yeah.
range?
Yeah. Generally, we're looking for as broad as like 2 million in EBITDA to 10 million in EBITDA. I think the sweet spot is probably around 4 million in EBITDA. And so if you just assume that, we're talking about 20% margins, right?
Yeah.
Yeah. So you can extrapolate the revenue figures from there.
Right, right. I gotcha. That's good information to know. So I love stories. Audience loves stories. Could you talk about maybe one good one and one bad one? Like, let's start off with a bad one so we can end on a good note. But can you talk about maybe you've gone down the road, expended a lot of time, maybe even some money in due diligence or something,
Sure.
and you got to you know, the 1 yard line
Yep.
and things blew up. Yeah,
Yeah,
give us a
absolutely.
story.
So,
Yeah.
so I'll start with one of the earliest deals that I was looking at. It was with I found this company and got it under LOI within the first I want to say 4 months of my search fund launching. And this was a for-profit higher education company. They primarily made medical assistants, dental assistants, nurses, vet techs, HVAC technicians, welders. And it was a great business. It's an industry that gets a bad rap, but I think this school was really doing the right thing for its customers. It was, serving an underserved population of students.
Hmm.
And the deal seemed relatively straightforward. The owner, the chairman, wanted to sell it for a fixed, 35 million. In the previous 12 months, they'd done about seven. So, it was roughly a 5x multiple on the face of it, but I could tell just by looking at the numbers that it was going to do like 10 million that year. It was really on the upswing. And so, I was looking at it like it was going to be, a sub 4 multiple. I did more research within the industry and decided that that made a lot of sense. This isn't an industry that trades for, really high multiples, but it has really great, growth potential and it's doing good things. And boy, did this business cash flow. So, we're doing diligence. We're working towards closing the deal. Again, complicated deal, really big company, locations all over the United States. And, we get to about the time to sign, and the business had done really well. And it had taken about 5 months to get to that point. And the ownership came back and said they wanted more money. And I think that ultimately is what killed the deal, both from I'm not sure I could afford what they were willing to, sell it for. And then
Hmm.
also, I'm not sure I could trust trying to, continually retrade a deal given that they had already sort of, gone back on what they had said. And they had originally set that price at 35 million.
Wow.
And so that deal was difficult, financially. It was a huge time suck, and then it was also a burden financially for the fund. So that's a bad example. And maybe I should have seen that coming. Maybe I should have been planning for it, but that was a gut check. But
Gotcha.
then,
Yeah, good one
about
now.
yeah, about 2 months later, after I had looked at that deal, I found another deal in Texas, same industry. And the ownership was the children, the sons of the owners or the owner who had founded this school. And boy, great business. And so, while that deal ultimately didn't come together, it was very clear, why the owners wanted to sell. It was very clear, what they were willing to take for it. The business was in great shape. Everything was extremely straightforward. I actually ended up looking at that deal again with a private equity firm that was looking at it several months later. And so I think the key difference was the transparency. And so they were straightforward up front. They knew what they wanted. They were willing to negotiate, and ultimately, just through clear communication, we decided that there wasn't a way to work together. And I think my advice to them was, you should continue running this instead of selling it today because you're doing such a good job. Why would you take 4 or 5 times, EBITDA for this today? And they ended up taking that advice and moving on, and we ended up parting ways. And so, that's like a best case scenario for me is when I can move away from a deal, cut my losses early, and keep searching for that diamond in the rough.
Gotcha. As you look at the year ahead, right? We're well into this year, right? What are you most focused on tightening or improving within your investment or operating approach itself? In other words, your business. What are you looking at?
Yeah, so I'm trying to take a really hard 3-month run over the next 3 months, trying to increase, the quality of outreach and the quality of businesses I'm reaching out to, versus taking more of a quantity approach. And so that's, I think, the biggest focus that I'll have over the next 3 months is I'm going to be doing a lot more phone calling, a lot more research before I reach out to businesses, and trying to be much more of an industry insider and, provide a higher level of credibility to owners when I talk to them so that they feel good about, what I'm providing and how I'm differentiated from, other private equity, or strategic buyers.
Gotcha. Where do you think that things are less predictable rather, or less visible than you'd really want right now?
Yeah. So I think the biggest unpredictability right now is just trying to gauge what the economy is going to do over the next couple of years, what demand is going to be within these businesses over the next couple of years. Because, while you can look backward and say, gosh, this has been, quite a time of upheaval, ups and downs in the market, and you can see that in a lot of these businesses' numbers. It's even harder today with where we're sitting right now to know exactly how these businesses are going to grow. You can do industry research and realize, or I mean, and read that in a given industry is going to do 5 or 10% annualized growth over the next 10 years. But that's just a prediction, and these businesses are a lot of times much more cyclical than that. And so, in how I have to do a transaction, how much debt I need to put on the business, and the returns that my investors are looking for. They're looking for a much more concrete, guaranteed answer about where this business is going to go and how it's going to get there. And I think that's the biggest thing, is just trying to understand what the economy is going to do.
And AI ain't going to help you there because AI doesn't look at the future, can't look at the future, you
That's
know?
true.
Yeah, so you can do all the research you want, but we have an environment, we have wars, we have shortages,
Sure.
whatever. The worst thing right now is the price of coffee. It's just killing me. So just tell you, hey, just from a personal perspective, what would you say we try to keep these calls very non-adversarial, but at the same time, what would you say to the audience is your USP for coming in and having a portfolio company say, Matt, we want to adopt you?
Yeah, sure. So, I think I provide something very different than like a private equity firm, for instance. So, first of all, I've brought together a group of investors who are much more patient. A typical private equity firm is looking to buy and sell within 5 years. Their investment horizon is 5 years or less. And my investors are much more patient than that. I think most of them are perfectly fine with a 10-year investment horizon, and they're very flexible about how they achieve their exit, whether that's a stock repurchase or, a partial buyout or what have you. And so, with Josh Tree Partners, you're not going to have to worry about cost cutting, personnel slashing. You're not going to have to worry about bolting on a bunch of acquisitions that are going to ruin your culture. We're not in that world. We're really just trying to buy a business that is already functioning well, improve on it slightly if needed, and just take it to the next level. And so, in addition to that, with me, sort of what you see is what you get. I'm going to be the person stepping in, running the company on a daily basis, moving my family across country if necessary to run that company wherever it is. And it's not just going to be some faceless, nameless person who's, either running your company remote or, sending in a revolving door of people. So I think that's my biggest pitch. And I can speak from experience. My father sold his really small dental business to private equity back in 2017. And just over the last, I guess, less than 10 years, it's amazing the stories he's told me, phone calls he's received, emails he's received from his former employees, complaining about this company, who they're putting in charge, who they're firing, the, cost changes, the reorganization factors. And it's my understanding that that business has now traded hands like 4 or 5 times since that transaction. And so if you're worried about the culture of your business, the legacy of what you've built, and your employees, I feel much better offering, Josh Tree Partners as a solution to that than, suggesting private equity or a strategic buyer.
I like to use the analogy of commoditization versus legacy. It's like what is the owner really looking for? Like you said, if he just wants the cash right now, wants to get out, anything happen, he's 100 years old and got to take care of the family or something. Okay, you can see it, just go. We don't need you
Love that.
anymore. But yeah, for sure. So my favorite question, as you know, is if you could wave this magic wand, or you found this Aladdin lamp on the beach while you were jogging, right? And the genie comes out and says, Matt, one wish, any wish that you can apply to fixing your own business or your investments, what would it be?
Yeah, so thank you. Great question. And fortunately, I've had a little bit of time to think about it. For me right now, if I could wave a magic wand, my phone would start ringing, and that, perfect business owner would be on the other end with a great business. They're motivated to sell it for the right reasons. They're willing to take a reasonable price, and they really care about hand selecting the person that's going to be running their business and, taking care of their employees going forward. That would be, the ideal scenario.
Interesting. I was going to ask you this question as the last question, but you actually answered it, because I was going to ask you what type of founder would you want to work with? And I think you kind of said it right there, right?
Yeah, absolutely. I want a founder who's invested in their business, emotionally, and wants to see their business, continue to prosper, cares about their employees, and has built that culture within their business. And yeah, anybody who's willing to just help me transition a little bit into their role, who wants to sell their business, I want to buy your business.
All
I want to buy it
right.
and run it.
Matt, that was just great. Very, very important. How do people reach you?
Yeah, thank you. So joshtreepartners.com is where you can find me. All my contact information is up there. You can also just send me an email directly at matt@joshtreepartners.com.
All right.
And yeah, I hope to hear from you soon.
All right, great. Well, Matt, that was great. This whole idea of the search fund is kind of intriguing to me. I'm sort of a relationship-based kind of person, so maybe I'll go find a company to run. I think I could do that.
Yeah, you could.
All
Yeah.
right. So with that, I'll just say this is a wrap, and thank you so much for joining me on this episode of Leadership Strategy Foundry, Matt. It was a joy.
Thank you so much.
We hope you enjoyed the session and hope you picked up a pearl or two. Just a parting note, of the many business leaders to whom we speak, we find that one of their most pervasive issues is about filling their pipelines with qualified leads. If that's an area of concern where your organization could use an assist, head on over to aisolutionsfoundry.com and book a complimentary strategy session. This is one of our many programs that help organizations like yours build financial value that drops directly to their bottom line. See you on the next episode of the Leadership Strategy Foundry.